Hi there, Douglas here with Investing Lot. In this video, I'll share with you my strategy to find stocks with huge upside potential. Stocks that have the potential to double or even triple your money in the next few years. And make sure to stick around because at the end of the video, I'll share with you some strategies to maximize your returns if you have already begun building your portfolio. If you are paying attention to what's going on in the stock market so far this year, you know the growth stocks have in general been severely punished by the market in the first half of 2022. And you know, I'm always looking for a deal. So I think it's time for value investors to dig through the wreckage to see whether there are any deals out there, any treasures hiding in plain sight. Who knows? Maybe some growth stocks are now value stocks. But how do we find them? Want to find out? Let's get unlocking. First of all, what is a growth stock in the first place? Growth stocks, as the name suggests, are companies that are growing faster than the overall market. Or maybe they're not making any money yet, but analysts believe they will eventually bring huge returns due to their future potential. Some investors rather invest in growth stocks because they can earn profits rapidly from price appreciation instead of the slow and steady income from dividends. Because companies in this stage typically don't pay dividends. Instead, they will invest all their revenue into the business in order to stay ahead of its competitors and develop new technologies, which hopefully ensures they continue to grow faster and stay ahead of its competitors. Another important characteristic of growth stocks is that they frequently occupy promising positions in rapidly expanding industrial segments with extensive room for future growth. And because investors are so optimistic about their future and strong success the business might have had in recent years, investors are willing to pay premium for their stock. So, when we conduct evaluation of growth stocks, it is important to know that their price to earnings ratio is typically much higher than the overall market and industry peers. It is also important to know that since growth companies are viewed as more aggressive and volatile than defensive equities, risk plays a significant part in this decision. The challenge in investing in growth stocks is to find cheap or undervalued stocks that have a lot of growth potential in the future without having to pay too much for the stock today. To be able to accomplish that, we have to find companies that have strong fundamentals in place, but the market hasn't noticed or recognized yet. In other words, the stock's current price does not fairly reflect the company's actual value. Now, that is the challenge, isn't it? So how do I find them? Pay close attention. The first thing you got to do is to smash the like button and subscribe to our channel. Alright, joking aside, I'm not joking. Go ahead and subscribe. See, it's free and information is power, brothers. Anyway, the best way to find growth stocks that are undervalued is to use a stock screener. A stock screener will filter through all the junk out there, and I will share with you my strategy in a minute. Most stockbrokers have them, but you can find them on financial sites such as finviz.com and Yahoo Finance. I'll use Finviz stock screener for the purpose of this demonstration in this video. Stock screeners have the purpose to assist you in sorting stocks according to the criteria and parameters you desire. Think of it as a matchmaker of a sort, because people should look for potential investments in a similar way as they look for a long-term partner. When you're going long on a stock and you are in for the long term, it's like starting a relationship with someone. You've got to be more selective because we are actually looking for a long-term commitment over here, aren't we? So getting back to business terms, unless you're betting against a stock you should be always looking for companies that have a huge growth potential, solid balance sheet, and solid business fundamentals. In this case, we are on the hunt for the growth stocks that have huge potential for growth and are also selling at a discount. So these are two keywords we have to keep in mind: growth and discount. Now let's head to finviz.com and click on the Finviz stock screener and talk about the criteria and parameters that I recommend. Because of the current state of instability in the markets and high volatility, at this time I will be only searching for bigger companies, the top of the food chain, the apex predators. So with that in mind, my first parameter is market capitalization. The smaller the market capitalization or market cap, the riskier the investment, especially in current times. Because looking for growth stocks during a bear market is a risk endeavor. Therefore, I like to focus on mega caps first, or companies that are valued at over $200 billion. That's right, the big kahunas. So far, we have 39 candidates, 39 companies that are above the $200 billion market cap. By the way, if I can't find any companies with the parameters we are looking for, then I can circle back and try the next leg down, which are large caps from 20 billion to 200 billion. Well, let's move forward. The second thing we will do is we are looking into growth rates. Remember the keywords: growth and value, potential and discount. Therefore, we will set a target for future earnings growth rate. Fast growing business are a great location to start your search for quality businesses because tons of investors love them. On the screener, you will look for the EPS growth next 5 years under the tab Fundamentals. We will start at the 10% annually and see what we get. And I know 10% seems low, but remember, we are in the middle of a bear market and financial analysts are expecting we may be heading to a possible recession. So far, at 10%, we have 25 candidates. Still, in the growth department, it's also a good idea to see how the company has been doing in the past. We will go ahead and look into the EPS growth for the past 5 years, and we will set it for above 10%. That way, we can see which companies are consistently delivering good results. Consistency is good. As you see, little by little, we are filtering the candidates, and 5 companies didn't pass the last criteria. Now we have 20 candidates. Now that we saw companies that have the potential to grow compared to their peers, we will start filtering for value. Ladies and gentlemen, that's right, discounts, deals. We are looking for the buy one, get one free type of deals. To accomplish that, we will use the price to earnings ratio to find potentially undervalued stocks. This criteria will help us to search for companies that are undervalued or inexpensive. The PE ratio allows investors to evaluate the stock value and is simply the result of the division of the stock's current price by its annual earnings per share. It tells investors how much money they need to put into a company in order to get $1 of earnings from that company. If you pay a lower price for earnings, you are getting a better deal. When all things considered, of course, we will set the PE ratio to under 30. Because remember, we are looking for high growth companies, so they typically carry a higher PE ratio than the overall market. So now, we essentially cut off that list of candidates in half. What? We are separating the wheat from the chaff here, guys. As only 10 or 11 made it so far. Absolutely great. Next step, I'll check the company's profitability and make sure they have high profit margins. For Two reasons really. First reason is that I love that dough. I love them greens, them Benjamins. Love it. And the second reason I'm looking to cash machines is because having healthy cash flows and pricing power is a pretty good thing to have in times of recession, because it means they still have some wiggle room to bring prices down if a bad recession is around the corner. So let's go ahead and select net profit margin to high, like sky high, above 20%. Bam! And that cuts the list in half again and brings the list down to 5 survivors. 4 based in the US and 1 based in Taiwan. 5 high quality, well-known names that I would probably be comfortable owning for the long term. But I'm not done yet. I want to add a little extra cushion in terms of safety and liquidity. You don't want to invest in a company that has liquidity problems, solvency problems in a certain times, do you? I know I don't. So I will add a liquidity ratio, just to be sure. We know that the current ratio is a good way to check if the company may have some liquidity problems. A ratio under 1 indicates that the company's debt due in a year or less are greater than its assets. So I want to avoid them, especially in current economic conditions. And I will add a current ratio above 1. In fact, let's do above 1.5. So we see that pharmaceutical giant Merck was cut out of the list, which is fine. And last but not least, I will borrow a little from the technical analysis side here, just a little. I will add a parameter to search for stocks that are trading at least 20% below their all-time high. If your list is still too long, you can consider adding a few more parameters, or you may increase the minimum growth rate to 15% if you wish. But so far, what do we have here? We have a total of 4 companies, 4 survivors that pass a strict set of parameters. The cream of the top. And what do they have in common? They are all giant multi-billion corporations. They all have a history of growth with tremendous growth potential, where financial analysts are expecting they will continue to grow at considerable high rates in the long term. They are all undervalued and selling at a discount compared to their peers. They are all very profitable business and are trading at least 20% below their all-time highs. So, ladies and gentlemen, this is my strategy to find potential multi-baggers in the safest ways possible. But don't think your work is done here. The screener is just a start. You need to do a little due diligence on your own and do more research about those companies. Find out why such attractive stocks look so cheap. If you don't know the company, you should research it. Find out what it does, or if the company or industry is facing any problems. Was there any change in management? What is the company intrinsic value? If you don't know how to calculate it, I recommend you looking into a series of investing like a pro. And if you decide to purchase your stock, you want to keep up with what's going on with the company. So how do you maximize your returns? Growth companies have a tendency to be volatile. So even while you should aim to hold each investment for at least a few years, you should still keep an eye out for substantial price movements. One thing you should always consider doing is rebalancing your portfolio. If a component of your holdings has appreciated to the point that it now controls the majority of your holdings, this increases your exposure and portfolio risk. Therefore, consider selling some or rebalancing your portfolio. The second thing you should do is to keep an eye on the company's value. If the price of a stock significantly exceeds your assessment of its value, you may want to think about selling, especially if you have a more affordable purchase in mind for the money. And The third reason you should consider selling is if the company has experienced a period of difficulty that contradicts your original investment thesis or the primary motivation for purchasing in the first place. Remember my video of Peter Lynch's legendary class? Major errors made by the management team, a long-term loss of pricing power, or a competitor with cheaper prices, all result in the thesis being invalidated. Okay, if you are still around, and I'm glad you are still enjoying this video, do me a big favor and press the like button so others can have access to the same content. And go ahead and subscribe to our channel if you haven't done yet, because you won't want to miss my next video, where I will be doing a more in-depth analysis of the best growth stock to buy right now. Sort of a continuation of this one, if you will. Remember, this video should not be taken as financial advice. You should always do your own due diligence. Thanks for watching, and I'll see you very soon.